can think of a bond as like an IOU. You lend your money to the company and they agree to pay you principal and interest when they say they're going to. So what happens in Australia when companies get big enough, they can bypass the banks and borrow direct from investors like yourself. In contrast with a share or equity investment, there's no obligation to pay a dividend and there's no maturity date with the investment. You must decide to sell the share to recoup your investment. Investors can choose to be a banker or an owner and must weigh up the advantages and disadvantages of each. If you're a banker, you lend your money and you have the known interest repayment and principal repayment. Equally, if a company goes into wind up, you're sitting higher in the capital structure, so you can expect to get some, if not all of your payment returned to you, all of your capital returned to you. Whereas with a shareholder, you're taking on much more risk, you'd expect much higher returns, but there's no guarantee of your principal being returned to you or of dividend payments. In fact, in a wind-up situation, the shareholders would typically be wiped out entirely. As a bond investor, you're looking at the survivability of the company. What would cause that company to go into liquidation or wind up? So you're actually looking for diversification of income streams. The size of the company is really important. The bigger it is, the better it is. So a company, for example, like Wesfarmers that has varying income streams, if any one of those suffers due to economic climate, the others will support the company. So it's a low risk, Wesfarmers would be a low risk bond investment. On the other hand, with a share or equity investment, you're buying that investment with the expectation of growth. But we know that growth doesn't always happen. You're expecting the share price to grow and the dividends to grow, but the share price can fall and dividends can be cut. Did you know, for example, that during the GFC, all 4 major banks cut their dividends by at least 10%? As a bond investor, the only time you wouldn't be repaid is if a company goes into wind-up or liquidation. But companies will do just about anything to avoid this, as there's serious consequences if they do. Some of the measures include a rights issue or cutting the dividend to preserve capital and protect the bondholders that sit higher in the capital structure. In summary, if you're a bond investor, you have the certainty of income and principal being returned to you at maturity. Now, if you compare that with shares or equities, there isn't that certainty. There's not the certainty of dividends because they can be cut or not paid at all. And there's no certainty of capital being returned to you because you actually have to make a decision to sell the shares to recoup your investment.